$2 is $1 trillion. Let that number sit in your chest for a second, because that's not a headline and it's not a metaphor. That's a wager, an enormous, documented paper trail kind of wager that a huge wave of American homeowners won't make it to the finish line. And if your first instinct is to say, no way, good, keep that skepticism, just don't look away, because the next part is where it gets uncomfortable. These aren't random gamblers spinning a roulette wheel. The people placing these bets are the same people who build the roulette table, write the rules, measure the odds, and sell everyone the chips. They don't hope, they position, they model, they hunt for certainty. And if you've ever wondered why regular people always seem to find out after the move, it's because the move is often built months in advance inside the plumbing of credit markets. They see what lenders are writing today. They see what borrowers are stretching for today, and they see which loans are fragile today, and they see the calendar, when payments jump, when promotions end, when starter rates turn into real rates. That's why they can sound calm while everyone else argues on social media, because they're not debating feelings. They're tracking cash flows, resets, delinquencies, and the thin line between I can manage and I can't. So when Wall Street loads up on instruments that profit when homeowners default, when mortgages crack, when neighborhoods turn into discount inventory, the question isn't, could it happen? The question is, what do they see that most people don't? Now, quick, real talk. I'm running a campaign to push back against copycat channels that recycle other people's work and bury original creators. If you value what I'm doing here, hit subscribe and drop a quick comment. Type RJohnAG if you want, so the algorithm knows you're actually with me. All right, back to the number. And by the way, my analytics show something wild. A huge chunk of people watching right now are not subscribed. If you're getting value from this, fix that in 2 seconds. Subscribe. That small action is how you help me keep the research coming. $2, $1 trillion. If you've never looked at how modern finance bets against something, here's the simple version. They create and trade contracts whose value rises when certain loans fail. Those loans are tied to homes, your home, your neighbor's home, your parents' home, and the uglier it gets, the more those contracts pay. And here's the part that should terrify you. They're not gambling. They don't bet on uncertainty. They bet on certainty. They have information you don't have. They see patterns you can't see. Now, I'm not here to scare you for sport. I'm here to show you a pattern that's older than your mortgage, older than your neighborhood, older than the entire modern American housing system. And the cliffhanger is this. Once you see it, you can't unsee it. Because it doesn't just explain what's happening. It explains what tends to happen next. It's a pattern, a sequence, 4 stages, same rhythm, different costumes. And across centuries, across countries, across completely different economies, that sequence has snapped homeownership like a dry branch. Not once, not twice, over and over. So in this video, I'm going to walk you through the 4-stage pattern. Slow enough that you can feel the gears turning, but fast enough that you won't miss what matters. Then I'll map it onto what's happening in America right now. And by the end, you'll understand why the biggest money on earth is positioned for a foreclosure cascade, and what you can do to avoid becoming someone else's profit center. Before we dive deeper, one more thing. If you want daily updates, quick breakdowns, and my personal analysis that I don't always put on YouTube, I started a WhatsApp channel. Link is in the description. Join it because I drop premium posts there, plus instant voice notes and fast updates when something shifts. Now, let's build the map. And here's a promise. In a minute, I'm going to give you a simple red flag checklist you can run on your own situation in under 5 minutes. But first, you need the pattern, because without the pattern, the checklist feels like random paranoia. With the pattern, it feels like a seatbelt. 4 stages. Stage 1, credit gets easy. Stage 2, speculation becomes culture. Stage 3, math breaks. Stage 4, defaults avalanche. Sounds simple. That's the trap. Because the simplicity is exactly why it works. People miss it because it feels too obvious until it's too late. Stage 1, the credit expansion. This is where every housing boom is born, and it always begins with something that looks reasonable. Rates drop, lenders compete, new programs appear, down payments shrink, approvals get faster, the gate opens wider. At first, it isn't evil, it's responsive. More families can buy, more people move from renting to owning, neighborhoods improve, construction jobs rise, everyone claps. And the numbers even look healthy. Defaults are low, prices rise, but not in a cartoonish way. It feels like prosperity. Stage 2, speculative mania. This is where the mood changes. Rising prices stop being a side effect and become the goal. You start hearing the same sentences everywhere. Real estate only goes up. Buy now or you'll be priced out forever. Just rent it out. Someone else pays your mortgage. And as that mindset spreads, housing stops being shelter and becomes a trading asset. Flippers show up. Investors show up. People buy homes they don't plan to live in. They buy second homes, third homes, portfolios. And lenders love it because rising prices make the loans look safer on paper. The collateral number climbs, so the bank feels protected. So the bank lends more, easier, to riskier buyers. The cycle feeds itself. And this is where the media and the influencers unknowingly pour gasoline on it. They don't need to lie. They just need to repeat the highlights, the lucky wins, the fast flips, the people who made 6 figures in 6 months. Because every story like that convinces 10 more people to stretch. And stretching is what turns a normal market into a brittle market. Brittle markets don't bend, they snap. Stage 3, the breaking point. This is where the mathematics catches up. Prices have risen so much that the payment becomes a mountain. Incomes didn't climb at the same speed. And a market can only stretch so far before new buyers can't enter, no matter how creative the loan becomes. This stage is pure mathematics. Now here's where most people lose the game, even if they're intelligent. They fall into one of 3 traps. Trap 1 is denial. They hear market cooling and translate it as nothing changes. They keep spending like equity is guaranteed, and they ignore the warning signals until they're forced to act in the worst window. Trap 2 is delay. They know the payment is tight, they know the reset is coming, they know the job feels shaky, but they tell themselves they'll handle it next month. Next month becomes next quarter, and next quarter becomes a missed payment. Trap 3 is distraction. They focus on national averages while their own zip code is cracking. They argue politics instead of reading their own mortgage terms. They scroll through hot takes instead of building a cash buffer. If you avoid those 3 traps, you're already ahead of most people in stage 3. When the pool of fresh buyers dries up, demand stops rising. And the moment demand stops rising, the speculators who needed the next buyer to bail them out start to panic. Listings pile up. And if you're wondering what a foreclosure cascade looks like on the ground, it usually starts with small things that feel unrelated. A few more for sale signs, a few more price reductions, a few more homes that sit empty. Then you notice contractors getting quieter. You notice builders offering freebies. You notice rentals offering a free month. Those are tiny signals of excess supply. And excess supply is the oxygen of a downturn. The moment supply has oxygen, fear has fuel. Price cuts begin, homes sit longer. And the magic phrase changes from how high to why isn't this selling? Then the cruel truth arrives. Many owners owe more than the home can fetch. They're underwater. And underwater is where stage 4 breeds. Stage 4, the foreclosure cascade. Let me make it real with a quick story. Fictional, but built from real patterns. Meet Alex. Alex bought in late 2021. Great job, decent savings, tired of renting. Alex put 5% down, got a smart loan with a low starter rate, and told themselves they'd refinance later. Then rates jumped. Refinance became impossible. Prices in Alex's area cooled. Now Alex's home is worth a little less than what they owe, and the loan is scheduled to reset next year. Alex isn't reckless. Alex isn't lazy. Alex is normal. And that's the terrifying part. This cycle doesn't just punish bad decisions. It punishes normal decisions made at the wrong point in the pattern. So when I say check your mortgage, I'm not talking to a cartoon villain. I'm talking to Alex. I'm talking to millions of Alexis. This is the chain reaction that turns a slowdown into a collapse. Underwater owners who can't refinance and can't sell face a monthly bill for an asset that's shrinking. Some default because they're broke. Others default because, psychologically, it stops making sense to pay. Foreclosures add supply. More supply pushes prices down. Lower prices push more owners underwater. More underwater owners default. And the cycle accelerates. It's not a debate. It's a feedback loop. And feedback loops are scary for one reason. Once they start, they can outrun good intentions. A bank can want to help, but the loan still has to be paid. A city can want stability, but foreclosed homes still hit the listings. A government can announce programs, but paperwork takes months and defaults take days. That's why the first wave always feels manageable, right up until it isn't. Now, let me prove to you this is not a one-time story. I'm going to give you 3 snapshots, 3 different eras, 3 different places, so you can see the pattern repeating like a stamp. And while we do this, pay attention to one detail. After the crash, the people with dry powder buy what the families lose. That's not a conspiracy theory. That's how capital behaves when distressed assets hit the market. First snapshot, Amsterdam in the 1600s. Most people have heard the tulip story, a mania where a flower bulb could trade for absurd money. The meme of the 17th century. But the deeper story is what that mania did to property. When easy credit and trade profits filled the city, lending expanded. Merchants borrowed, property prices climbed. Stage 1. Then the bulb profits became a psychological accelerant. People wanted to store their gains in something real, so money poured into homes, warehouses, canal-side buildings. Stage 2. When the tulip market snapped, the paper wealth vanished overnight, but debts didn't vanish. Suddenly, the same people who looked rich yesterday couldn't cover payments today. Stage 3. Then came forced selling and then repossessions. Properties hit the market at discount after discount. Stage 4. And who stepped in? The people who had liquidity and patience. They bought the wreckage, they consolidated, they got richer. Different century, same mechanics. Second snapshot. Britain in the 1800s. Railways were real progress, real infrastructure, real economic benefit. And whenever real progress hits, money follows. And credit follows money. Banks lent against land near planned routes. Towns expected stations. Investors bought property in anticipation, stage 1, then stage 2. But speculation got ahead of reality. Land values priced in a future that hadn't arrived. People bought on rumors. Companies overpromised. The economics didn't match the hype. Stage 3. When projects stalled and plans collapsed, property that was about to be valuable became just land. Demand evaporated. Defaults climbed. Stage 4. And again, the winners were the ones who waited to buy after the fire. And if you want a more recent modern example that feels uncomfortably familiar, look at what happened in parts of Southern Europe after the global financial shock. Cheap credit flowed. Developers built like demand would never end. Second homes became a national obsession. Then rates rose, unemployment rose, and entire coastlines ended up with empty projects and bank-owned units. The story wasn't just prices fell. The story was the buyer pool vanished and the market became a liquidation sale. That's stage 4 in real time. Third snapshot, Japan's property bubble. In the 1980s, Japan was booming. Productivity, exports, confidence, banks lent. Rates were low, property rose. Stage 1. Then the culture shifted into certainty. Land became the ultimate asset. Companies borrowed against real estate to buy more real estate. Individuals stretched across decades. Stage 2. When rates rose, the math broke. Carry costs became unbearable. Buyers vanished. Prices fell. Stage 3. Then the long grind began. Years of falling values, trapped owners and banks weighed down by bad property exposure. Stage 4. Different language, same loop. So now, bring your attention back to America. Because the reason that $1 trillion number matters isn't just the number, it's where we are in the sequence. And here's my claim. We are not in stage 1. We're not even comfortably in stage 2. We are deep in stage 3, and stage 4 is knocking. Let's walk through the American timeline. Stage 1, credit expansion. After the last crisis, rates collapsed and stayed low for years. Mortgages got cheap. Monthly payments fell. Ownership became possible again for people who'd been shut out. At first, standards tightened compared to the worst days of the subprime era. On paper, it looked safer. Lenders demanded documentation. Credit scores mattered. The system acted humbled. But over time, competition returns. It always does. Programs evolve. Approvals speed up. Down payment requirements soften. Debt-to-income tolerance stretches. And a decade of low rates becomes an addiction for the whole market. Stage 2, speculative mania. This is where things got weird. And then came the pandemic era, an accelerant that poured lighter fluid on an already warm market. Rates dropped again. Stimulus checks hit accounts. People reimagined where they wanted to live. Remote work opened new hot cities overnight. And suddenly, a house wasn't just a house. It was an office, a refuge, a status symbol, and an investment all at once. That emotional cocktail made buyers do something dangerous. They bid like the future was guaranteed. Individuals began to treat their primary home like an ATM, cash out refinances, borrowing against depreciation to fund lifestyle or to buy another property. At the same time, institutional money discovered single-family homes as a product. They could borrow cheap, buy houses in bulk, rent them out, and package the cash flows. It wasn't family housing to them. It was yield. And when big buyers enter with scale, they change the market's physics. They pay fast. They waive things. They shift expectations. Then the behavior trickled down. Small investors chased the same trade. Flipping became mainstream. Short-term rental math became a religion. If the spreadsheet worked at low rates, it looked like free money. And for a while, the market rewarded it. Prices jumped. People felt smart. That feeling is rocket fuel. Homes started selling in days. Bidding wars became normal. Asking price became the starting point, not the target. And the myth hardened. This can't stop. That was stage 2. Stage 3, the breaking point. Then rates rose, fast. And this is where I want you to slow down and actually feel the monthly payment math. Because the monthly payment is the real boss of housing, not the sticker price. A home that costs one number at a low rate can feel doable. But push the rate up, and the same home becomes a different universe. The payment leaps, affordability collapses. And when affordability collapses, demand disappears, not gradually, suddenly. The market doesn't need every buyer to vanish. It only needs enough buyers to vanish that sellers can't clear inventory. That's when listings stack, days on market rises, price cuts spread. and the psychology shifts. Now, here's the part most people miss. Supply doesn't just come from homeowners. Supply also comes from builders finishing projects they started during the boom. Supply comes from investors who need to exit. Supply comes from people who plan to sell later, but now panic. And supply piled up right as demand thinned out. That is stage 3. Stage 4, the foreclosure cascade. This is where the story turns from prices are dipping into lives are changing. Foreclosures start quietly because at first, it's just the most stressed borrowers, people who stretched, people with little savings, people whose loans adjust. And that's the fuse in this current market. Adjustable rate mortgages resetting into higher rates. When you hear reset, don't hear a technical term. Hear a monthly bill jumping, sometimes by hundreds, sometimes by over 1,000. If a household is already tight, that jump isn't inconvenient. It's fatal. So the first wave is payment shock defaults. Then the second wave comes from price declines pushing owners underwater. Then the third wave comes when the broader economy cools and job losses rise. And those waves stack. Now, why would Wall Street place enormous bets against homeowners at this moment? Because those bets aren't really against you, personally. They're against the arithmetic of millions of loans at once. They look at schedules. They look at cohorts. They look at how many loans were originated in certain windows. They look at how many were adjustable. They look at how many borrowers had high debt ratios. They model how many households break when a bill jumps. They also watch softer signals that predict harder outcomes. They watch how many people are making only minimum payments on credit cards. They watch how often people tap retirement accounts early. They watch the percentage of income going to necessities, rent, groceries, insurance. Because when the budget is tight, the mortgage is no longer automatic. It becomes one more bill competing for oxygen. And the moment the mortgage becomes a competitor, the default risk rises. And the positions they build aren't always loud and obvious. Sometimes they're insurance. Sometimes they're hedges that quietly turn into directional bets. Sometimes they're products sold to clients that just happen to move money into the same side of the trade. And if you've never seen how these products are built, here's what you should understand. There's a whole industry designed to turn future mortgage stress into tradable profit. They buy protection and they short exposure. When you hear mortgage-backed securities, picture this. Thousands of home loans stuffed into one big bundle, sliced into layers, and sold to investors as a product. Some layers get paid first and look safe. Other layers get paid last and absorb losses first, which means they can be used like a lever. Tiny changes in default rates can create huge gains or huge pain, depending on which side you're on. Then there are swaps, basically insurance contracts, where one side pays a fee and the other side pays out if defaults spike. So yes, a homeowner missing payments can literally trigger payouts inside these contracts. And when those payouts become predictable, that's when the smartest money smells blood. And here's the next cliffhanger. The same groups that profit from stress also often show up later with fresh capital to buy distressed property. So even if you don't care about the financial plumbing, you should care about the end game. If a wave of foreclosures hits, homes become inventory. Inventory gets repriced, and whoever has cash at the bottom becomes the next owner class. That's why this matters. And if you think I'm exaggerating, ask yourself a different question. When the smoke clears, who do you think owns the homes? The families who are forced to sell into weakness, or the funds that buy after the drop? That ownership shift is the quiet story beneath the loud headlines. Now let me ask you something, and I want you to actually answer in the comments because I read them. Do you think home ownership should be primarily for families or primarily for funds? And second question, if you already own, what's the one thing you're most worried about? Payment shock, job stability, or home values? Drop your answer below. Quick reminder, if you want more breakdowns like this, subscribe. It takes one tap. Also, quick creative detour. If you're into silver-related success stories, regular people who built wealth in ways nobody talks about, there's a link in the description to another channel. Subscribe over there too and watch how people have actually made money, step by step. Now, let's get practical. If the pattern is real, and history says it is, what do you do with that information? I'm not here to scare you. I'm here to give you a checklist. If you're thinking, okay, John, but what about me specifically? Here's a fast self-audit. If your mortgage payment is more than a third of your take-home pay, you're in the danger zone. If you have less than 3 months of expenses saved, you're exposed. If you have high interest debt and you're paying only minimums, you're fragile. If your job is commission-based or tied to a cyclical industry, you need extra buffer. You don't need to be perfect. You need to be aware. Awareness is how you buy time, and time is how you buy options. First, know your mortgage. This sounds basic, but you'd be shocked how many people don't know their own terms. Are you fixed rate or adjustable? If adjustable, when does it reset? What index is it tied to? What is the cap? What is the worst case payment? Don't guess. Pull the documents. Check. Second, run the ugly math now, not later. Take your current balance and simulate your payment at a higher rate. Even if you think rates will fall, don't build a plan on hope. If you can afford the higher payment, you're safer than most. If you can't, you have time right now. Time is the only advantage most people ever get in this pattern. Third, build a buffer. In stage 4, the people who survive aren't the people with the biggest house. They're the people with the biggest margin, cash cushion, lower monthly obligations, flexible options. If you can cut expenses and build reserves, do it before you're forced. And for homeowners thinking about selling, here's a move that can save you months of stress. Price for reality, not for ego. In a shifting market, the first seller to accept the new reality often gets the best outcome. The last seller clings to yesterday's comps and ends up chasing the market down with repeated cuts, looking desperate, losing leverage. If you need to sell, focus on speed and certainty. Clean the listing, fix the obvious issues. Offer a credit for repairs instead of fighting inspections. Be open to buyers with financing, not just cash. And if you're buying, remember, you can negotiate again in stage 3. You can ask for concessions. You can ask for closing cost help. You can ask for inspections without being laughed out of the room. That shift in leverage is one of the first good things that happens for regular people after a mania ends. Fourth, if you're stretched, start thinking in timelines. Foreclosures don't happen overnight. It takes months, sometimes a year or more depending on location and process. That timeline can be used to plan, not panic, but planning requires honesty. If you're on the edge, you need to admit it while you still have choices. Fifth, if you're renting and waiting to buy, don't let internet pressure rush you. The fear of missing out is a weapon in stage 2. Stage 4 is when the deals come, after the forced selling, not before. That doesn't mean never buy. It means buy when the market is offering value, not when the market is begging you to overpay. Sixth, if you're an investor with thin margins, respect the cycle. If your deal only works when everything is perfect, low vacancy, low rates, rising prices, then your deal isn't resilient. In stage 4, resilience wins. Seventh, don't wait to talk to your loan servicer until you're drowning. If you feel stress coming, income unstable, expenses rising, call early. Ask what options exist. Modification programs, term extensions, rate adjustments, repayment plans. Sometimes the best move is boring. A longer term, a smaller payment, more breathing room. And if you ever face the worst case scenario, you need to understand your local rules. In some places, lenders can pursue you for the difference after a foreclosure sale. In other places, the property is the collateral and the lender's claim ends there. That single legal detail can change the smartest decision. Also, protect your credit like it's a second income stream. Late payments hit fast, collections hit harder. A foreclosure can shadow you for years. So even if you decide to sell, do it before you miss payments because once the credit damage starts, options shrink. Now, I also want to say something that might sound odd in a housing video, but it matters. If any of you are doing well, if you've built something that works, if you've found a strategy that saved you, if you've climbed out of a mess, share your success in the comments, not to brag, to give other people a blueprint and a morale boost, because the worst part of a financial storm is feeling like you're alone in it. And if you're the type who likes signals, here are 4 you can watch without being an economist. 1, mortgage delinquencies, especially early stage delinquencies. That's the canary. 2, inventory and days on market in your zip code, not national averages, your local market. 3, the share of listings with price cuts. When cuts become normal, psychology is changing. 4, rental softness. If rents stop rising or vacancies rise, investor math breaks and investor selling can follow. If you see all 4 turning at once, you're watching stage 4 begin to breathe. Now let's talk about the objections. I know you're forming because you're smart. You should challenge this. This time is different. Unemployment is low. Lending is safer. The government won't let it happen. The central bank will cut rates. All of those might be partly true. But here's the issue. Stage 4 doesn't need perfection. It only needs enough stress in enough places at the same time. Payment shock plus falling prices plus tighter credit plus slower hiring. The combination creates cracks, and the cracks spread. Also, even if policymakers intervene, interventions often slow the process rather than erase it. They can delay, they can soften. But they rarely reverse the full loop once it's moving, because the loop is built on incentives and math. Now, I want you to hold this thought. Wall Street doesn't need the entire nation to default. It only needs a meaningful percentage. And when a meaningful percentage defaults, the market reprices. That repricing changes everyone's psychology. A home that felt like a guaranteed win becomes a risky asset. People stop stretching. They stop bidding wars. They stop paying any price. That shift alone can pull values lower. Now remember the end game I mentioned. Distressed buying. If foreclosures rise, some buyers will step in. But the first buyers are often the ones with cash and scale. They buy in bulk, they buy cheap, they rent back. And in that world, the American dream quietly changes shape. It becomes subscribe to rent. Now, before we continue, I need to mention something important. By the time you're watching this, there's likely already a members-only video published where I put all the updates in one place. Every key shift, the newest signals, and the deeper analysis. If you want the in-depth version and you want to prove you're really following, join the membership and watch that members-only update. Premium members get more detailed breakdowns as things evolve. Now, let's zoom in on the parts of the market that can trigger the fastest damage. 1. Adjustable rate resets. 2. Investor-owned inventory. 3. New construction finishing into weaker demand. 4. Consumer debt strain. Let's talk about resets again, because this is the quiet killer. In a low-rate world, adjustable loans look clever. The payment is lower, the buyer can qualify, the monthly cost feels manageable. But in a high-rate world, adjustable resets can ambush a household. And payment shock doesn't negotiate. It just arrives. Some borrowers will refinance, some won't qualify. Some won't have enough equity because prices dipped. Some will have lost income. Some will have other debt. And when they can't refinance and they can't absorb the new payment, the default starts like a drip. Then it becomes a leak. Then it becomes a burst pipe. Second, investor-owned inventory. Investors are not families. Their relationship to the property is different. If a family is underwater, they might still fight to keep the home because it's school districts, memories, stability. An investor underwater sees a spreadsheet. If the spreadsheet stops working, they exit. So investors can create fast supply in a downturn. They list, they sell, they cut price quickly. That accelerates declines. Third, new construction. Builders started projects when demand was hot. Those projects finish later, even if demand cooled. So the market can be flooded with fresh inventory at the worst moment. Builders respond with incentives, then price cuts, then cancellations. That can anchor lower prices for comparable homes nearby, pulling the whole neighborhood's values down. Fourth, consumer strain. When households are loaded with credit cards, auto loans, student debt, and rising costs, they have less slack. Housing stress becomes the tipping point. And when a lot of households hit a tipping point together, you get systemic behavior. Now here's the part that should make you sit up. Big money can profit in both directions. They can profit on the way down through protection and shorts. Then they can profit on the way up by buying distressed homes cheap and renting them out. Downturn profits, recovery profits. That's why they can be calm. They're not emotionally attached. They're positioned. So what's the plan for you? I'll give you a 5 moves framework. Move 1, information. Know your terms, know your payment risk, know your equity. Move 2, margin. Reduce fixed expenses, build savings. Avoid new debt. Move 3, optionality. If you need to move, don't wait until you're forced. If you need to sell, don't wait until everyone else is selling. Move 4, community. Use the comments, ask questions, share what you're seeing in your area. Are listings rising? Are price cuts common? Are investors dumping? Move 5, mindset. Stop treating a home as a guaranteed profit machine. Treat it as a long-term stability tool. If it profits, great. If it doesn't, your goal is still to survive. Now, I want to bring this full circle with a final thought that most people ignore. Patterns don't repeat because humans are stupid. Patterns repeat because incentives are stable. Lenders profit from lending more when prices rise. Investors chase returns. Borrowers stretch when they feel fear of missing out. Policymakers prefer short-term relief, and markets eventually demand payment for excess. That is why the 4 stages keep coming back. Credit gets easy. Speculation becomes culture. Math breaks. Defaults avalanche. So when you see enormous financial positioning against mortgages, don't treat it like gossip. Treat it like a weather report from people who own satellites. It doesn't guarantee your exact street floods, but it strongly suggests a storm system is building. And here's a simple way to help yourself and help others at the same time. Use the comments like a local radar. Tell us what you're seeing where you live. Are homes sitting longer? Are builders discounting? Are investors listing? Are rents soft? When hundreds of people share those small observations, a pattern shows up before the headlines. And if you've already solved part of this puzzle, paid off debt, refinanced, built a buffer, drop your win below. Someone reading might copy your smart move instead of copying someone else's bad one. Also, don't forget, the WhatsApp channel link is in the description for daily updates and voice notes, and the members-only video pulls everything together in one place for people who want the deeper, no-fluff version. And if you want me to cover your specific situation, renting versus buying, fixed versus adjustable, selling versus holding, leave a question in the comments. I can't answer everyone, but I do pull themes from your questions for future videos because your real-life cases make this content sharper. Your question might save someone else. Now here's my ask. If you want to support this work and help me push back against the copycat machine, make sure you're subscribed and leave a comment. Again, even a simple RJohnAG helps more than you think. And join the WhatsApp channel in the description if you want the daily posts, the instant updates, and the voice notes that don't always make it into these videos. And If you want the full premium breakdown, check the members only video that should already be live by the time you're watching. One last thing. If you've navigated a tough market before, 2008, a recession, a layoff, anything, tell your story in the comments. Somebody reading needs that perspective right now. Because whether Wall Street is right about the exact timing or not, the pattern is still the pattern. And the people who survive aren't the people who deny the pattern. They're the people who prepare while everyone else argues. So look at your terms, run the math, build margin, and keep your eyes open. Because if this moves into stage 4 the way history says it can, the headlines will be loud, but the real damage will be quiet. One missed payment at a time, one forced sale at a time, one neighborhood at a time. And that's exactly how $1 trillion bet gets paid. And for the people waiting to buy, here's the most honest sentence I can give you. You don't need the lowest price. You need the right terms. If you buy with a payment, you can comfortably afford. At a price that gives you margin, you can live through a downturn without panic. If you buy stretched at the edge of your budget, even a small downturn can trap you. So don't just watch prices, watch payments, watch your cushion, watch your job stability. And if you're already in a strong position, fixed rate, affordable payment, emergency fund, don't let doom content steal your sleep. Preparation is not panic. But if you're stretched, don't let optimism steal your time. Time is the rarest asset in stage 3. Because once stage 4 is fully visible, it's usually already late. In the next video, I'll break down the exact timeline indicators that tend to flip right before foreclosures surge, so you can see the shift before the headlines catch up. I'll see you in the next one.